I think that there are a lot of things at play when they knocked it down. The answer is yes. But I think you have to examine what happened when they knocked it down. I mean, it got knocked down in 2 days. You saw in both instances, a couple weeks ago, you saw massive amounts of gold and silver dropped in what's called the access market. It started anyway at a period of time in between New York closing and Asia opening. There's no liquidity in the market there. And when this happens, it would be the worst possible time to ever do it. In fact, there wouldn't be a trader on the planet that would ever do it. If they did, they would be fired and shot, and probably not in that order, as you're dumping copious amounts of gold and silver onto the market when the New York traders are gone for the day and there is no liquidity in the marketplace. And it hits stops because there's no one there to fill the order, so it just triggers stops all the way down. It's a drive-by shooting. The interesting part about it was that Michael Lynch, I believe is his name, I think that's his name, an analyst who talks about the COMEX, says, there was interesting movement when the price got slammed down. Two American commercial banks came in and bought massive amounts. It was Bank of America and Morgan Stanley. They came in and literally silver went right back up and gold came up about halfway because it had hit so many stops on the way down, where funds that use algorithms to, trigger sell limits or sell orders just fall. The interesting part about Morgan Stanley and Bank of America is you have the chief investment officer, of course, of Morgan Stanley. It's well known now that said, sell half your bonds and put 20% of your assets in gold. And Bank of America lead analyst Michael Hartnett is saying, make that 25% in gold. And so these two banks came in and gobbled it up. But when you look at how this has tremendous strength and resiliency, I look back over my career, Adam, and any time that the market got hit this hard, they'd step on its neck and it would never come back. Everyone was saying, this is it, it's over. Gold broke 4,000, silver broke 50, the bull run is over, sell your gold. It never left, and it was done. If when the media said that, they said, by the way, the start of this massive sale happened when no rational trader would have ever done it. It was dumped in the middle of the night when there was no liquidity. This would have been done over hours or days during New York trading, not bang when there's no one there. If they would have said that, I think the market may have looked at things a little bit differently. I think U.S. commercial banks who have changed their allocation recommendation to gold came in and scooped up physical on the cheap. There are a lot of games going on, bottom line. And I think you just have to have strong fingertips and see the bigger picture. It looked as though the banks involved were European banks and Scotiabank were the ones that sold. And drive it down. Look, there are problems where these banks have very large short positions and they're exposed. And a silver market that gained nearly 40% in 2 months, to your point, a correction was inevitable. That is the definition of overbought. But I think there are a lot of banks and a lot of big players who were off sides in a very big way. And you could argue it was dumping in order to cover short positions and an opportunity for other banks. I don't know. All I can tell you is that there is no rational explanation to dump it at a period of time when there's no liquidity in the market. You would do it judiciously, slowly, in New York trading. And again, to your point, it's also important to remember that even with this sharp correction, when you talk about silver, it's up over 65% this year. And gold is up over 50% this year, even with these pullbacks. But to me, it's not even as much who or why as it is what. Why would anyone do that? There's just no possible explanation for why anyone would dump it at a period of time to trigger all of the selling. It's a drive-by shooting. It's done for effect. Maybe it was rescuing stale short positions for one entity or an opportunity for others. But the bigger question is, why even do it to begin with? It would be the least opportune way to maximize this massive gain that you would have had if you're selling, unless that's not what it was. I mean, when you talk about at the institutional level, I would argue that you're running into serious supply constraints. I mean, you look at the central banks and their numbers are usually backed up a little bit, but in September they bought 39 tons of gold, which was up 79% month over month. And it's the highest month of reported net buying in 2025 so far. And you're continuing to see massive amounts of gold bought across the board. You look at Now, I've talked a lot about Tether and their role in the stablecoin legislation and how they are buying gold and Bitcoin with their profit. Their numbers on their third quarter balance sheet are almost 13 billion in gold. They're buying gold hand over fist.
Wow.
When they issue these stable coins, to back whatever it is that they're doing, they're backed by U.S. treasuries, and the interest on those treasuries is not transferable moving forward. And they will put more and more into gold. They were just at the Beaver Creek Mining Summit, so they're dealing directly with the miners now as well. And so I think whether you're talking Tether or the central banks or the massive deliveries into COMEX or the massive deliveries in Shanghai, at the highest level, you're seeing a rush, a quiet rush for physical possession, huge amounts. And I don't know, I just think that this inventory problem will only get worse. Now, it's ironic that we haven't seen it as much on the retail level, but we're beginning to in certain areas. And I don't know if there's any coincidence or just it's the inefficiency of the U.S. Mint. But the U.S. Mint, the product availability is horrid and the premiums are out of control. Right now on gold buffaloes, you're going to pay about $300 over spot to buy a gold buffalo. They're as rare as hen's teeth all of a sudden. American Eagles, $200 over. Silver Eagles, $7 or $8 or $9 over. I mean, the premiums are all of a sudden on U.S. Mint products. They haven't made a Platinum Eagle in years. As a side note to all of this, you want to kind of draw a line between conspiracy and reality. I would urge everyone to go to Road to Ruda's website or to YouTube channel Big Swear and watch this 3-part series with a man named Jack Sermon, which was done a couple of years ago. I remember almost falling off my chair hearing it. Jack is the guy that developed the Eagle program for the U.S. Mint, and under Janet Yellen, he said he was told by his superiors, who would have been Janet Yellen, the head of the Treasury, to only mint as many Silver Eagles, the fewest amount possible, without creating a global revolt. He admits this, and he's been at the Mint since '86, since they started doing it. There is no question that the U.S. Mint is by far the hardest mint to get product from reliably, in my opinion, at a reasonable price. But I wonder, is it starting to spill down into this side of the market? Because you're beginning to see people wake up, not the thousands of sales, everyone buying, tiny little bits, but on high levels, we're seeing very, very, very large orders, and a lot of it in gold. What does it mean? I'm not quite sure, but simply to say, at the top, it's not getting any better. Is it starting to trickle down? Yeah, maybe it is, but it hasn't reached Main Street yet.
Every time I think I've seen it all in this market, something new happens that makes me stop and say, wow, that's a first. What we just witnessed with gold and silver getting slammed in the middle of the night was one of those moments. I've been doing this for decades, and I can tell you straight out, no rational trader, no professional money manager, no sane institution would ever dump that much metal into an illiquid market between the close in New York and the open in Asia. That's not a trade. That's a message. It's like a financial drive-by shooting. You pick the moment when there's nobody on the street, pull the trigger, and watch the chaos unfold. And that's exactly what we saw. Massive amounts of gold and silver dropped into the access market, a period so thinly traded that even small orders can move price. It's the worst possible time to sell, which means it wasn't about selling at all. It was about control. It was about resetting sentiment, triggering stop losses, and giving the illusion that the run is over. Now, the interesting part, and this is where it gets good, is what happened after that slam. 2 big American commercial banks, Bank of America and Morgan Stanley, came in like hawks and bought massive amounts of physical metal. Think about that. The same 2 banks whose top analysts have just gone on record saying institutional investors should be holding 20 to 25% of their portfolios in gold. Bank of America's Michael Hartnett even said recently that 25% in gold is not overweight, which for a major institutional strategist is a radical statement. Morgan Stanley's chief investment officer went even further, telling clients to sell half their bonds and move into gold. These aren't fringe analysts on YouTube. These are Wall Street institutions managing trillions of dollars. So ask yourself, if gold and silver are being dumped, why are the biggest U.S. banks scooping it up immediately after? You think that's coincidence? No chance. This was an orchestrated shakeout. Somebody needed to cover shorts, Somebody needed to reload physical at lower prices, and as usual, the retail investor is left chasing headlines while the real money makes its move in silence. And you know what's funny? The same mainstream talking heads who scream gold's bull run is over conveniently left out the most important detail, that all this selling happened in a window of near zero liquidity. They didn't tell you that no legitimate trader would unload that kind of volume when markets are asleep. They didn't tell you that gold bounced back within days and silver clawed back most of its losses. Instead, they parrot the old narrative. See, gold failed again. That's propaganda for the paper markets. If you zoom out, you see the bigger picture. Because even with those sharp corrections, silver's still up over 65% this year, and gold's up more than 50%. Show me another asset class with that kind of performance amid the most aggressive tightening cycle in decades. And remember, that's after the beatdown. So when I look at what's really happening, I don't see weakness. I see strength and resiliency. I see a system that's fighting to keep control of a price it can no longer contain. Now let's talk about why these attacks even happen. It's not random. When prices spike too far, too fast, it exposes the fragility of the system. It forces shorts to cover, it stresses delivery pipelines, and more importantly, it risks waking up the broader public. Because once average investors start realizing that these metals aren't just shiny rocks, they're insurance against monetary corruption, it's game over for the paper manipulators. But here's where things get even more interesting. When that midnight slam happened, it wasn't just retail traders that noticed. Analysts tracking the COMEX pointed out that the instant the price crashed, physical deliveries surged. Bank of America and Morgan Stanley were two of the biggest buyers. Meanwhile, European banks, like Scotiabank and others, were the ones doing the dumping. So while the Western media called it a sell-off, what it really was a transfer from weak hands to strong hands, from Europe to America, from paper to physical.
Real quick, you bring up one very interesting point, and that is this. Here's the stage that is set for a massive battle. You have the industrials, Tesla, Samsung, whatever, Sony. You have the hedge funds. Ooh, they smell blood in the water. Mm-hmm. And now the third and fourth piece to that puzzle, U.S. government just officially lists silver as a critical mineral, putting a floor under the price. And China is now limiting exports moving forward. There is a battle going on, not only to drain the world's exchanges slow enough as to not cut off your nose to spite your face so everything blows up. And you have governments acknowledging that this is more about policy now, not just national security and policy on top of the battle between the industrials and the investors. It's setting the stage. And when you realize just how small of a market cap silver has, I don't tell people to buy silver to get wealthy, but it has enormous upside if you realize that you start throwing government money into this and putting a floor under it and limiting exports. Yeah, the potential for silver is quite enticing. I mean, you could argue it's parabolic. You know, it's funny. It's the United States Geological Survey Commission. It's part of the government. They're also the ones that came out a year ago maybe and said that they could see silver being the first element struck from the periodic table of elements. They publicly said that. But yes.
Because we're running out of it?
Yes, because it's found in nature in a form called epithermal, like your skin is epidermis. Mm-hmm. The big deposits were found very, very long ago. I was listening to an interview that Keith Neumeyer was giving the other day, and he was saying a lot of the primary silver companies are actually moving more towards being gold mining companies, right, because it's so difficult. Of the 850 million ounces mined last year of pure silver, there was only roughly 20% of that 170 million or so that came from companies mining silver. It's so hard to find the deposits because they're right near the surface. The big deposits were found forever ago. So First Majestic, I believe, is the purest of all the silver companies in terms of their just being a silver company. It represents 50% of what they do, but
right,
it's becoming really hard to find, is the bottom line, the big deposits that have already been exploited. So most of what comes to market is byproduct mining of other minerals, and they stumble across it. Silver comes from Mexico, Peru, and Canada. And it's interesting, I mentioned Mexico and Peru. The Chinese are going right to those miners and saying, we'll pay double what the West will. We want your doré, which are the crudely refined bars. We want your concentrate, which is the byproduct mining sludge. And we'll pay double, we'll send it back and refine it ourselves. Now, this is coming from the second largest producer of silver on the planet. David Morgan will tell you, when he went there to tour the mines, China told him, we're number one, we're not number two. Whatever they are, they're massive producers of it, and they're all around the world to buy stuff and refine it themselves. When we almost entirely need silver, when we need silver, it's almost entirely coming from other countries. We are reliant upon it on other countries, and that is a fragile supply chain. It's not a good thing. At the same time, you got China building deep water seaports in Peru and trying to build their infrastructure. I mean, there is a game of chess going on right now that people really aren't seeing. And that game of chess is who can secure all of the world's commodities. Shh, don't tell, do it quietly. Don't freak everyone out. But this is a battle of gaining supremacy on the commodities of the world. It's shifting from paper promises by the West into who's got the goods around the globe.
When I talk about the gold and silver markets right now, I keep coming back to one word: resiliency. You can knock it down, you can suppress it, you can manipulate it, but you can't kill it. Every time the price gets hit, physical demand explodes. That's not weakness, that's strength. That's proof that the paper market's control is slipping. I think back to the 1980s and 1990s, when a price smackdown like we just saw would have ended the bull market for years. But not anymore. The moment gold and silver drop, buyers appear out of nowhere. Asia steps in, sovereign funds step in, central banks step in, and now even commercial banks are stepping in. That tells you the world is shifting. The old saying, follow the money, has never been more true. Look where the wealthiest players are going. Bank of America, Morgan Stanley, Goldman Sachs, all of them are rebalancing toward gold. The World Gold Council just reported that institutional allocations are at their highest in modern history. In the West, it's being spun as a hedge. In the East, it's being treated as a weapon. And that's not hyperbole. China and Russia have openly stated they're building a commodities-backed financial system. The BRICS nations are buying record levels of gold and silver. They're not trying to trade, they're trying to replace the dollar. And that's why these price attacks are happening. Because the Western system knows the dam is breaking. Now let's talk about how ridiculous that access market dump really was. If you're a legitimate trader trying to unwind a position, you do it strategically, slowly, with liquidity. You don't dump billions of dollars of metal when half the planet is asleep. The only reason to do that is to create panic. It's psychological warfare. They want to trigger stop losses, hit algorithmic sell orders, and flush weak hands out. And once the dust settles, guess who's there with open arms? The very same entities that caused the drop in the first place. They're buying what you're panic selling. It's the oldest trick in the book. Shake the tree and grab the fruit. And it works every time because most investors still think this is a free market. It's not. It's a managed illusion. The COMEX doesn't reflect real supply and demand. It reflects the financial engineering of a handful of players with massive leverage. But here's the part they can't control: physical depletion. The more they suppress the price, the faster the physical drains. And the faster it drains, the closer we get to the breaking point. When there's no more silver left to deliver, no more gold to lease, no more ETFs to shuffle, the illusion collapses. We're already seeing the early signs. COMEX eligible inventories, the metal owned by customers, are fine. But registered inventories, the metal available for delivery, are evaporating. Shanghai's silver stocks are at critical levels. The LBMA's vaults are being emptied to fill demand in Asia. The arbitrage between spot and futures has turned into persistent backwardation, an unmistakable sign of physical stress. And yet, through all of this, the narrative stays the same. Gold is boring, silver is volatile, buy tech stocks. You want irony? Nvidia's market cap is now worth more than every ounce of above-ground silver in the world combined. Let that sink in. One AI chip company is worth more than the physical foundation of modern civilization. That's not innovation. That's insanity. You can feel something's breaking. You can sense it in the tone of the institutions. For the first time in decades, Wall Street isn't mocking gold bugs. They're joining them. When the CIO of Morgan Stanley says gold is now a core holding, when Bank of America sets a $67 price target for silver, when even Bloomberg starts covering bullion sales at Costco, you know the tide has turned. The stigma is gone. The revaluation has begun. Meanwhile, at the grassroots level, you're seeing a quiet awakening. People are buying metals not out of greed, but out of fear. They're not trying to make a quick buck. They're trying to opt out. They see inflation eating their savings, governments debasing their currencies, and central banks weaponizing the financial system. They want something real. And that's the essence of this moment. This isn't a trade, it's an act of rebellion. Now, I'll tell you what worries the establishment most. It's not price, it's participation. They can handle a $100 move in gold. What they can't handle is millions of people waking up and realizing the emperor has no clothes. That's why they need the volatility. They need to scare you out. Because if too many people start demanding physical, the system implodes. So when you see these flash crashes, don't panic. Recognize them for what they are. Last-ditch efforts to maintain control. The same playbook they used for decades in oil, treasuries, and even currencies is being applied here. But this time, it won't work. Because unlike fiat or futures, gold and silver can't be printed. And here's something that still blows my mind. Despite all this chaos, gold and silver have outperformed nearly every major asset class this year. That's right. Despite the manipulation, despite the volatility, despite the headlines, precious metals are beating stocks, bonds, and real estate. That's not weakness, that's dominance. Now let's talk about the US mint fiasco, because it's symbolic of a much bigger problem. You can't find product. Premiums are exploding. The mint hasn't produced a platinum eagle in years. Silver eagle supply is erratic. Gold buffaloes are as rare as hen's teeth. And when insiders like Jack Sermon, the man who literally built the Eagle program, say the Treasury told him to limit production intentionally, you realize it's not incompetence, it's design. They don't want widespread ownership. They want scarcity. They want control. It's the same reason central banks preach diversification, but never mention gold to the public. They buy it for themselves while telling you to buy index funds. It's the same reason ETFs are promoted as convenient, even though you don't own a single ounce. It's the same reason gold is taxed as a collectible while debt is rewarded with deductions. The system is engineered to keep you away from real money. But that's changing. Every cycle ends. Every manipulation eventually runs out of ammo. And we're nearing that point. The banks are repositioning, the institutions are hedging, the insiders are exiting the paper casino and moving into tangible assets.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.